Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at DataVault AI.
If you find our talks useful, please consider subscribe, like, and comment underneath to support our podcast. And if there's any stock you want us to look into, leave it in the comments section below.
So let's get into the analysis.
Okay, so let's unpack this one. When you really look at DataVault AI, this isn't your standard growth stock.
No, not at all.
You're looking at, well, a full-blown corporate demolition and reconstruction. It's a fascinating, and I have to say, a very high-stakes turnaround story.
That's the perfect way to frame it. The company's legacy, their old focus, was in audio hardware.
Right.
And they're essentially just throwing all of that out to build something completely different and, potentially far more valuable.
It's a huge pivot, not just a small adjustment.
Exactly. It's a leap from legacy hardware into the future of enterprise AI. They're ditching that old low-margin product sales model.
And the new focus is
Right.
it's all high-margin stuff, right?
All high margin. We're talking AI-driven data valuation, data tokenization, and IP licensing.
So moving from selling, I don't know, physical gadgets with slim profits to selling digital trust and insights.
You've got it. It's a structural transition. The goal is to flip the entire company into a recurring software and services model, what we call ARR.
Annual recurring revenue. And that's the holy grail for investors.
It is, because that model promises much higher gross margins, predictable revenue, and, a much higher valuation than you'd ever get with hardware.
Sure. But, moving from hardware to data requires a massive physical backbone. You can't just announce it.
No, you have to build it.
And that's where this nationwide SANCM private edge cloud rollout comes in, right? That's the foundation for this whole new paradigm.
It is the literal foundation, and the scale of it is, well, it's breathtaking. That's why it's so risky, but also has such a high reward potential.
How big are we talking?
They're not just testing this in a few cities. The stated goal is a rollout in 100 U.S. cities in 2026.
100 cities, that's incredibly ambitious.
Immensely.
Yeah.
But if they pull it off, that scale defines their entire addressable market.
And those market numbers are just huge. The data suggests that just the first installations in New York and Philadelphia, they're targeting markets over $2 billion each.
Per metro. Think about that. So the full 100-city rollout implies an opportunity in the, tens of billions. It's a massive target.
That sort of scale, though, it brings up the question of competition. If you're going into a space this big, you need a moat, a real advantage. What's theirs?
The moat is, it's really two-pronged. Starts with the IP. Their core strength is their patented data tokenization and valuation stack.
Okay, let's slow down on the jargon a bit. What does that stack, data value, data score, and IDE, what does it actually do for a big bank?
It solves the trust problem. This system allows for real-time scoring, audit-ready valuation, and this is the key tokenization at birth of data streams.
So the data is basically authenticated the second it's created.
Yeah, exactly. You eliminate massive compliance and security headaches for those regulated industries right from the start.
Okay, so the IP makes the data clean. The second part of the moat must be the physical network itself, the SANCM network.
Correct. It's designed to be completely different from a public cloud like AWS or Azure. It uses a zero-trust, quantum-resilient edge fabric.
And quantum resilient, that's the future-proofing part, right? It matters for data that needs to be kept secret for decades.
Precisely. Financial services, governments, they can't have their data vulnerable to a quantum computer that might exist in 10 years. This private edge fabric offers security and speed that public clouds just can't match for these specific use cases.
And they've gotten some serious institutional validation for this, which must help. I'm thinking of the expanded collaboration with IBM.
Oh, that's huge. Using IBM watsonx for enterprise AI at the edge, that IBM stamp of approval connects them directly to the big enterprise world, gives them credibility.
Credibility is one thing, but let's talk hard numbers. Building a 100-city network costs a fortune. How does that show up on the balance sheet right now?
Well, as you'd expect, the current financials look weak. Current EBIT is negative. Financial health is categorized as weak.
And for many investors, that's a huge red flag.
Of course. But in this context, that negative EBIT isn't a sign of failure. It's the cost of admission for this kind of infrastructure play.
They're front-loading all the capital.
Exactly. They are building the foundation now for billions in recurring revenue tomorrow. You're investing in the expansion, not in current stability.
And they've been creative with funding it. That $150 million Bitcoin infusion from Silex was a big deal.
A massive boost to the balance sheet. And what's really interesting is how they're using their own equity. They registered 7.5 million shares.
But not to cover losses.
No, specifically for IP acquisition. That signals management is focused on aggressive growth, on strengthening their long-term assets. It's a very bullish sign.
Let's shift to the near term because the market has definitely started paying attention to all this.
It really has.
We saw that huge momentum breakout, right? The price was up, what, almost 180% after the 100-city rollout news?
A sharp reversal from where it was. That kind of move tells you the market is finally waking up to the scale of this pivot.
And we've seen analysts get more confident. The Maxim Group bumped their price target from $3 to $4.
Right, which suggests they believe there's still significant upside, even after that huge initial spike.
So what are the concrete catalysts we should be watching for? What proves this is moving from a plan on paper to, well, to actual infrastructure in the ground?
First and foremost, you watch the master purchase order with available infrastructure. That MPO is the execution structure for the whole Sanctum deployment. Progress there is proof.
And then there's the more experimental side of things, the experiential marketing.
Yes, the DVHO holographic displays and the ADIO spatial audio. This is where the AI meets the real world, trying to lure in high-end clients.
Like the Reflessi Fifth Avenue collaboration. The hologram itself is flashy, but the real play is the data it generates, isn't it?
Absolutely. The hologram is the lure. The real monetization is the anonymized engagement data they capture. We should see progress on that revenue stream by February 2026.
They're also using Web3 tools. I have to admit, the meme coin part of this seems a little strange.
The Dream Bowl meme coin token, yeah. 1 token per 60 shares? It sounds odd, but you have to see it as an engagement tool.
How does that work, though? How does a meme coin help an enterprise AI company?
It creates a built-in community. They're seeding their new ecosystem with motivated participants, their own shareholders. And those new platforms are coming soon.
Right, Q1 2026 for the Elements Exchange and the NIL capabilities.
Correct. Those platforms are designed to leverage all this new tokenized data and turn it into tradable assets on their network. It's all about driving transaction volume.
Okay, we've covered a lot of the bull case. But a story this ambitious has to come with huge risks. I mean, 100 cities in 1 year sounds almost impossible.
That is the primary execution risk,
Yeah.
the sheer scale and speed of it. They have to overcome that negative EBIT profile, which means they need rapid customer adoption. They need to sign big contracts fast.
Otherwise, they just burn through capital and have to dilute shares.
Exactly. The company is structured for flawless execution. Any slip in that timeline, and they'll face a capital crunch.
And the stock's volatility reflects that, doesn't it? Up 77% 1 week, but still down 39% for the year. That shows how fragile the conviction is.
It's very speculative right now. And there's still skepticism around some of the newer initiatives like the holograms. Will brands really adopt them at scale?
Is there any kind of safety net here?
There is a small one. The master purchase order for the build-out has a 90-day termination right, so they can slow down capital spending if they need to. It gives them some flexibility.
So ultimately, the risk is structural. It's a massive growth story that depends entirely on near-perfect execution over the next 1 to 3 years.
It's a sprint, not a marathon. They have to prove they can drive this thing at top speed right now.
So, to sum it all up, this is the definition of a high-risk, high-reward scenario. The entire investment thesis hangs on this pivot from niche tech to a sovereign edge AI infrastructure provider. If they execute, we could see a massive earnings expansion by 2028.
And with that $4 price target from analysts, the big question is whether the market is still deeply underpricing the long-term value of owning this unique infrastructure. Especially as the world gets more and more worried about relying only on centralized public clouds for sensitive data. If you want to keep up with these high-growth opportunities, make sure you hit that subscribe button for Smart Wealth with Joshua.